Volatility. We, when we started to plan this call, we thought that maybe things might be a lot different now than they actually are. Volatility has settled down. Yesterday, the market was volatile, to be sure. The market actually closed up on the day. And today, we have the same thing. We are actually up a little bit today. So to put all this in perspective, I think what is going on is we're having some normal ups and downs in the market. What has happened since 2009, for example, we've had one decline of 6.6% on a single day. That compares to 2.1 on Friday and 4.1 on Monday. So again, going all the way back to 2009, we had one 6.6% decline. That's not normal. And I think what's happened is we have grown accustomed to a very, very tranquil market that goes up. It seems like incessantly it just goes up. So on the plus side, we've had two markets that have gone up a lot, both in 2009, 7% and 6.3%. So we've had this very, very stable market over a number of years, and any kind of ripple, I think, shakes the confidence of investors anyway, but perhaps even more so now because we're not used to it. So people say to us, well, what are we doing about this, or what are we doing differently? And really, when we buy the stocks for you, when we buy our securities, we have to assume that things won't always be great. We proceed by buying companies that we're comfortable with and we're confident will do well year over year over year and aren't dependent on only the best conditions in order to survive. So what caused this decline in the market? What caused this ripple? You know, no one knows for sure, but I do think that the one concern the market may have right now would be the rise in interest rates. And that actually began 2 years ago now. And I haven't concluded anything, but I think the bear market in bonds actually began in 2016. And what we're seeing now is a delayed reaction to that reality that rates they have in fact been going up. The Fed has been doing that, and they've stopped the quantitative easing, and they're beginning to sell bonds back into the market to reverse that. But I think there's a kind of a recognition that has all of a sudden hit the marketplace. And there's this fear, which I can understand, but I think it's unwarranted, that will the market, the economy continue to grow as interest rates rise? At this stage, with interest rates as low as they are, I don't think there's any question about that. The market can do that. Then you have the other issue of inflation. All of a sudden, inflation is beginning to catch the eyes of many investors. It was not a concern for the longest time. And now we're beginning to see these little pop-ups that are occurring, and people are wondering what that might do to inflation and interest rates. And then we also have a weaker dollar, which is actually set in last year. That could prove to be inflationary. There are a number of things that are happening that could prove to be inflationary. But it was only about a year ago when we were looking for inflation. We were concerned about deflation, and we were trying to convince people that they shouldn't really be worried about inflation. That is, the Fed's ability to create kind of a creeping inflation. I think we're beginning to see that, and all of a sudden the rules are changing a little bit, and it may be that the market just got a little dose of anxiety. Most stock investors we speak to, most I talk to, have little or no confidence in the market, and they haven't for many, many years now. And that's normal for this stage of an economic expansion, particularly one which has not been very robust. and particularly for one that has not really been tested. Once we get tested and investors get confident that every time the market goes down, I'm going to buy the market because we'll have higher highs in its aftermath. I talk to a few people who say that, but I know they don't really believe it. And I think we'll move into that period. But for now, everything's fragile. I don't know that this volatility is over, but I think the key to making money in the market is to stay the course, particularly now, because I still see a great bull market unfolding in front of us. And before this great bull market is over, I would be shocked if we didn't have at least 3 bear markets, at least 3, and numerous corrections. And to date, we have not had a single bear market since '09. Once we get into the second or third and the economy is really beginning to heat up, we're nowhere near that happening, then we can begin to worry. But now I think we buy and hold stocks. I think things look really, really good to me. The biggest concern is how we will react as investors in general, universally, to nervousness, volatility. The concern I have is primarily interest rates. A lot of people just have too much money in bonds, and they're going to get nervous when they begin to see the declines in prices. They do not understand it. They don't understand that if interest rates go up 1% on a 30-year bond, the value of that bond goes down nearly 20%. They do not understand it, but they will. That's the nature of every boom bust. And if there's a boom, it's been a Federal Reserve-induced reduction in interest rates, a great bull market in interest rates. And when that ends, that's what the market's worried about. And in my opinion, if interest rates go up 0.5% or 1%, it doesn't really matter. Interest rates don't go up quickly. They go up very, very slowly, almost imperceptibly. If you go back to those 15% interest rates we enjoyed in 1981, it's quite a few years since 81 when that happened. It took a long time to get to where we are. It'll take a long time for those rates to get as high as they were back then. But in the meantime, we're cautious about bonds, and we're very, very optimistic about what we see for the market, in spite of the inevitable bear markets that have to occur. Kevin, why don't you jump on here and make some comments, and then we'll try to do some questions.
Sure. I think the overall message, though, that we want to send is one of optimism in our outlook, and that a lot of what's going on right now is reflecting a return to normalization in the markets. We haven't had a correction in the market since the winter of 2016, and we define a correction as decline of 10% or more, and that this current market hasn't reached a correction yet that we're in right now, and that even if the market were to go into correction, the positive points outweigh the negative. We have unemployment at a 17-year low. Average hourly wage growth last month was the best in 8 years. All reflecting what are signs of a healthier and economy and financial normalization. And keep in mind that we're coming out of a period of years of low and insufficiently inconclusive economic growth. The stronger economic growth will feed into larger segments of the economy, and that the higher interest rates are simply a reflection of what we see as stronger economic growth. Now, bear in mind, when we say high interest rates, you have to note that they are at historically low levels, and even still with the bump up in rates. Given that they are historically low, it's still a very favorable environment for equities. Earnings are improving, and the recent tax cut will act as a tailwind to much of the market, and we look for the market to end the year higher than it is currently. And that's my thoughts on the current environment, and looking out, it's one where we want to stay the course and continue to buy quality companies. And I feel very good about the outlook for our investors.
Well said, Kevin. Well said. And we have, again, I think this is just one of those things that we need to accept and tolerate. But the long run, still, everything seems to be rosy to me. For every problem we can identify, there are at least two pluses to offset it. And by the way, the weak dollar I mentioned is not necessarily a negative. It's actually a plus. It might contribute to a little bit of inflation, but from an economic business point of view for us, it's actually a very big plus. So with that, maybe we'll ask if you have some questions.
I'd like to ask a question. Tom and Kevin, I'm your Cape May neighbor. Yes. Some of the things that I've been reading that are the general advice to people as they age are, as you get older, you should hold less equities and more bonds. And I think you're kind of encouraging us, if wealth permits, to do the exact opposite of that. Is that true?
Yes, with the following caveat. Clearly, I think a number of you, not all of you, but a number of you, have enough wealth, enough money, that it's unlikely that you will spend it all. And income clearly is so low from buying bonds and CDs that, adjusted for inflation, it's very, very difficult, in some cases impossible, to get a positive real return. So those of you who read my quarterly letter that we did about a month ago now, maybe 3 weeks, even if you go back and look at what's happened in stocks and bonds over the last 15 years, there have been rewards for those who have been in stocks. But that was also during a period when we were in a bull market for bonds. And what I keep saying to people is, when interest rates start going higher, you don't want to be in fixed income. And so part of me says, yes, Tom, absolutely. We do favor stocks. We favor stocks for most investors to 60 to 70% of their total invested. It can be less, particularly for people who are older and also have a shorter, span to draw on the funds. Once interest rates start to rise, a 2 or 3% increase in interest rates results in a 30-year bond declining by more than half. That's a lot. And I started in 1968, 69, and I know what happened to fixed income investors during that period. When we were actually taking AAA rated tax-free bonds, and people were getting 50 cents on the dollar for them. Now, I'm not forecasting or projecting anything that looks like that. But once the bear market sets in, being in fixed income is not a good place to be. There are two reasons to own fixed income. One is income. We clearly don't get any in today's market. The other is diversification. The diversification remains in place, clearly, but not for income. It's just not there in a real sense. So, yeah, we are giving somewhat the reverse advice, but not to the extreme. 60 to 70% for most of our clients would be better advised in stocks at this time than bonds. And in that ratio of 60-40, 70-30. Any other questions?
I have a question. We read in the papers and the news about all of this computerized trading that was driving a lot of they said like 60% of the sell-off was due to computer programs. And I'm not really sure I understand that or what the implication is for that.
Well, part of it is, we say that human beings are emotional, and they are. But there are a lot of trades that are being done based on someone selling. That is, once selling comes into the market, the robotic, automated response to selling is sell. So we get into these periods when you can get an obvious result. It kind of gets to the point where, let's say, the human element says, this is ridiculous, I will come in and buy. Now, having said that, though, the volatility we've witnessed really isn't that extreme, but that's really what it is. Selling in a program sense creates more selling. And but the way I look at it, it creates opportunity, because if the machines are selling because somebody is selling, it creates an opportunity for people who know fundamental values and can, get in the way of that and scoop up values. And I believe that's what's happened here in the last few days.
Hey, Tom, this is Mike.
Yes. Hi, Mike.
So are you saying then that there's going to be a time where there's going to be a buy? Okay. In other words, remain as it is now, but somewhere down the road, okay, there's going to be some kind of a buy opportunity.
Yeah, I think that what we'll find is, yes, I think what we'll find, Mike, is that as the market declines, it will make new higher highs. And that's what we would expect at this stage in the market. Yes, it will go down, but when it does go down, new highs. Now, if you compare that to the period of the aughts from 2000 through 2009, that was a long-term bear market. And when the market went down, it didn't go up as high, generally, from where it had previously declined. And when it went down, it made new lower lows. And then, of course, that blew off in 2009 when the Great Recession was clearly in place, and we really realized what was going on. But I think we're going to have the reverse of that now. We're now, I think, in a secular bull market, and each decline will be followed by a higher high. That's what we want to be in. That's what we want.
Good. So basically, if I were your advice, stay the course.
Stay the course, yeah.
Thank you.
Any other questions? Kevin, do you want to say anything to close this now?
Thanks, Kevin.
You're very welcome.
Well, you
Everybody
might
have a good day. Yeah.
Mention how our fixed income approach, given the outlook for interest rates and them rising higher, is pretty well designed to protect investors, because we do not invest in long-term treasuries that are vulnerable to price declines with rising interest rates.
Right. That's a good point, Kevin. Very good point. Our fixed income portfolio, in spite of the fact that the market is down for bonds, is actually up through today, from the first of the year, and that's because our strategy does not embrace the risks in the market. I'm not saying it won't go down, but it doesn't embrace the risks that we're talking about. We've set up purchases, and we own securities that in some cases will benefit from a rise in interest rates, and most of what we own is shorter term, so we won't get the same impact as rates rise. So we provide the diversification, some of the income in our bond strategy without the risk. And I think, Kevin, I'm glad you brought that up. It's important for everybody to know that and understand it.
It's an important point because a lot of investors that are simply buying bonds because they think they're safe if this market continues. When they get their next quarterly statements, they own 10, 30-year Treasury bonds, are likely in for a rude surprise. But we don't own that part of the market, and in fact, because we do own the shorter term bonds, as they mature, we're buying replacements at a higher yield.
All right. For those of you who care, if, and I don't think any of you on this call did it, but there was a 30-year U.S. Treasury bond sold 2 years ago. The interest rate was 2 3/8%. It matures in 30 years. Currently, is worth about 80 cents on the dollar. That's what we're talking about. And if you owned it, you'd realize it. But when we talk about bonds being safe, they can be safe, and that means they're money good. You'll get your money back. But there is an interest rate risk in every bond. And the interest rate risk is simply, if rates go up, the value of whatever it is you're getting is diminished because there's a higher rate available in the market. And that's true for every kind of bond issued. However, if you own a 6-month maturity, or a 1 year, or 2, or 3, that risk is obviously very small because it will mature and you'll be able to roll it over at a higher rate.
Hi, Tom. This is Margaret. I just have a quick question. If we have transferred some long-term bonds, should we get out now or ease out of that? How do you think we should handle if we do have some positions with long-term bonds?
I haven't. Well, Margaret, I have to be honest. I haven't seen that. Have they come in? Are they with us right now?
I'm not sure what we could deal privately if you want on our own particular situation. If you want.
Okay. Well, yeah. I would say we've tried hard, and maybe what you're calling long term, we're not calling long term. No, that's
okay. Anything under 3 years, you're thinking is?
Oh no. Oh no. 3 years it wouldn't be. When we talk long term, we're really talking about 10 years or longer, okay. And particularly 20 to 30 years is where we would say that we need to understand the risk, okay. The interest rate risk. But I don't think any of that applies to you.
Great. Okay. Good news.
Okay. Good. Any other questions?
Tom, I'm going to ask one more question related to charitable giving. That's knowing the not-for-profits that I work with, everybody's very, very nervous about whether charitable giving will fall apart with the standard deduction going up to $24,000 for a couple. But if you give more than that, it sounds like you'd still be able to itemize your deductions and do okay. Do you have advice for people that are, usually give maybe in the $5,000 to $10,000 gifting range per year?
Yeah, I think what we're going, as a matter of fact, we are going to do a tax call next week, and I think Art Dicker and Donna Casey will be speaking of what we're calling doubling up. And one of the strategies that we're going to talk about on that call would have to do with, let's say you have a person who the standard deduction makes charitable giving not as attractive. What they could do is if they had the money, they could take 3 or 4 years of contributions and put them in a donor-advised fund and because that would be in the year they made the donation into the donor-advised fund, get the benefit of the deduction, and then make the contributions as they would have over the next 2, 3, 4 years from the donor-advised fund. So there are strategies that we're going to be employing. For those of you who don't know, Hippo Tax is the tax arm of Curran. We're starting that strategy. The other one that we're doing is doubling up to try to get people to combine their real estate taxes into 2 years by prepaying 1 year and then doubling up and then getting above that threshold, but staying below that threshold, I'm sorry, so that they can at least get the the break on some of the money.
Yeah.
On this using the standard deduction, or I'm sorry, actually taking advantage of it rather than losing it. But Art is going to have more to say, and Donna will have more to say about that. And to answer your question, Tom, do I think that if so many people say that the small contributors are so important to what they do, based on that, I would say intuitively those contributions will go down. But I'm also thinking that a lot of people who make those contributions are those people who are less likely to think about the tax benefit. I think it's the larger contributors who think more in terms of the tax benefits, but that's just my guess. That's a hunch on my part. So I don't think it will really hurt too much where small contributions are the force.
I'll get back on next week for the report.
Okay, good.
Hi, so Tom, this is Kelly. I just want to let everybody know on the call. So that event will be next Wednesday at 2 o'clock. There will be an invitation going out via email tomorrow to everyone. So certainly take a look in your email for that tomorrow, and we will have all of that information for you. It will also be recorded, just as this teleconference is being recorded. So if you aren't able to participate live, we will have a recording available after the fact. So more to come on that, and check your emails tomorrow.
Okay, good. We're going to try to hold these calls to a half hour so we don't, burden anyone. And so we're going to shut this one down. I do thank you all for coming on.
Thank you, Tom.
Thank you.
Kevin.
Thank you, Tom. Kevin.